Most people believe their money faces a difficult legal process after they die. They assume the government takes a large portion and the rest gets tangled in court for years. The reality is more specific. The federal estate tax applies only to estates worth more than $13 million, which excludes virtually all American families. What actually costs ordinary families significant money is something else entirely, and it is largely preventable. This video runs the real math on what happens to your money when you die. When you die, your assets do not automatically flow to your family. They transfer through a legal process determined by several factors: whether you had a will, how your accounts and property were titled, whether beneficiaries were named, and the laws of the state where you lived. Some assets pass directly to named beneficiaries outside the court system entirely. Life insurance death benefits, retirement accounts with designated beneficiaries, and jointly held accounts with right of survivorship all transfer automatically. These assets bypass the probate process and typically reach your family within weeks of your death. Other assets must pass through probate, which is a court-supervised process for validating your will and distributing your remaining estate. Probate takes time and costs money. For most families, understanding which assets bypass probate and which do not is the central practical question of estate planning. For this analysis, we model 3 different financial situations and trace what happens to the wealth in each. The first involves a modest estate with no advanced planning. The second involves significant retirement savings with named beneficiaries. The third involves a larger estate approaching the estate tax threshold. Our first case is a single adult who dies in her early 70s. Her estate is worth approximately $300,000. It includes a checking account with $18,000 inside it. A standard brokerage account holds $120,000. The home is valued at $150,000. A vehicle rounds out the remaining assets. She had a will. She had not engaged an attorney to review it or prepare any other planning documents. Because she owned each of these assets in her name alone, with no designated beneficiaries and no joint ownership, everything must pass through the probate court. Probate costs vary significantly by state. In California, attorney fees for probate are set by statute as a percentage of the gross estate value. The statutory attorney fee on an estate like hers is approximately $9,000. The executor receives a matching amount. Court filing and administrative costs add roughly $2,000 more. Total probate costs on this estate approach $20,000. That represents roughly 6.5% of the gross estate. This does not include the time cost. Probate proceedings in California typically take up to 2 years to resolve. During that period, all assets are frozen. The family cannot access the checking account, cannot sell the home, and cannot manage the brokerage portfolio. Any immediate financial needs must be covered from the family's own resources while the court process runs its course. The most effective solution for most estates is a revocable living trust. Establishing a basic trust with an estate planning attorney costs approximately $2,000 for most families. Assets titled in the trust name bypass probate entirely. The trust does not reduce taxes, but it eliminates the court process and the associated delays dramatically. For assets that cannot easily be moved into a trust, beneficiary designations serve the same function. A retirement account with a named beneficiary bypasses probate entirely, regardless of what the will says. The account transfers directly to the named person within a matter of weeks. This detail surprises many people. If your will directs assets to your child, but your retirement account names your ex-spouse as beneficiary, the retirement account goes to your ex-spouse. Beneficiary designations override the terms of a will. Keeping these current is among the most impactful and least expensive actions in estate planning. Our second case involves a married couple with substantial retirement savings. He holds a traditional IRA with $400,000 inside it. His wife is the named primary beneficiary on the account. When he dies, she inherits the IRA. A surviving spouse has options unavailable to any other type of beneficiary. She can roll the inherited IRA directly into her own IRA. She continues growing the account tax-deferred, takes required minimum distributions based on her own age, and treats the account as if she had always owned it. This is the most favorable tax outcome available under current law for inherited retirement accounts. But when she eventually dies, the adult children inherit whatever remains. Under the Secure Act passed in 2019, most non-spouse beneficiaries must withdraw the entire inherited IRA balance within 10 years of the original account owner's death. Distributions can be taken in any pattern during those 10 years. The account must be fully emptied by the end of the 10th year. This 10-year rule has a significant tax consequence. Suppose the children inherit a traditional IRA with $500,000 remaining. They must withdraw that entire amount within a decade. Every dollar withdrawn is taxed as ordinary income in the year it is received. If each child withdraws their proportional share over the full period, that amount adds to their regular earned income every year. In that tax bracket, the annual additional tax on those distributions is roughly $5,500 per child. Over the full period, the additional tax burden per child reaches roughly $55,000. For a family with multiple adult children, the combined additional tax burden can easily exceed $100,000. This outcome is not an edge case. It is the default result when a large traditional IRA with no Roth conversion is inherited by non-spouse beneficiaries in working-age tax brackets. There are strategies that reduce this burden during the original account owner's lifetime. Roth IRA conversions move money from a traditional IRA into a Roth IRA, paying income taxes now at the current rate. Inherited Roth IRAs are also subject to the 10-year withdrawal rule, but qualified withdrawals from an inherited Roth are income tax-free. If the conversion is done while the original owner is in a lower bracket than the children will face during the distribution period, the conversion reduces the family's total tax cost over time. Qualified charitable distributions offer another approach for IRA owners past age 70 and a half. Directing IRA distributions directly to a qualifying charity satisfies required minimum distribution obligations without creating taxable income. This reduces the IRA balance during the owner's lifetime and reduces what the children face under the 10-year rule. The federal estate tax has a threshold that most people significantly underestimate. In 2024, the exemption is $13,600,000 per individual. For a married couple, portability rules allow the surviving spouse to claim the unused exemption of the first to die. The combined protection available to a married couple can exceed $27 million. This means the estate tax is irrelevant for roughly 99% of American households. The families that need active estate tax planning are those with significant business interests, large real estate portfolios, or investment accounts approaching the individual threshold. There is a significant change on the horizon. The elevated exemption was created by the Tax Cuts and Jobs Act of 2017. That provision sunsets at the end of 2025. Absent new legislation, the exemption reverts to approximately $7 million per individual after inflation adjustment. Families with estates above $7 million but below the current threshold will face potential estate tax exposure that does not exist today. For the vast majority of families, the more impactful tax consideration is the step-up in basis. When you inherit an asset, your cost basis for tax purposes resets to the fair market value on the date of the original owner's death. This is called the step-up in basis. Its financial impact is often enormous. Consider an investor who purchased stock 40 years ago. The original cost was $10,000. By the time of death, that stock has grown to $200,000. The embedded capital gain is $190,000. If the investor had sold the stock during their lifetime, capital gains tax would apply to the entire gain. Long-term capital gains are taxed at 20% for most higher-income investors. At that rate, the tax bill on this gain reaches $38,000. If the investor holds the stock until death, the heir inherits it with a stepped-up cost basis of $200,000. If the heir sells the stock immediately, no capital gains tax applies. The full gain disappears for tax purposes at the moment of inheritance. This step-up is among the most valuable provisions in the tax code for transferring wealth between generations. It rewards holding appreciated assets until death rather than selling them during life. Real estate, stocks, and other capital assets all receive the step-up. Retirement accounts do not, because they were never subject to capital gains treatment in the first place. Life insurance is the final asset class in this picture. Death benefits paid from a life insurance policy to a named beneficiary are generally free of income tax, regardless of payout size. A policy that pays out $1 million delivers that full amount to the named beneficiary as non-taxable income. Life insurance proceeds are included in the gross estate for estate tax purposes if the policy owner was also the insured. But for families whose estates fall well below the estate tax threshold, this distinction is rarely material. The real math behind what happens to your money when you die is not primarily about estate taxes. It is about the mechanics of how assets transfer. Assets with current accurate beneficiary designations pass quickly and without probate. Retirement accounts, life insurance, and payable on death bank accounts all transfer outside the court system. Naming beneficiaries correctly is the single most impactful action most people can take in estate planning. It costs nothing. Assets without beneficiaries or joint ownership enter probate. On an estate of that size, probate in California costs roughly $20,000. That process can take up to 2 years. A revocable living trust, which costs approximately $2,000 to establish, eliminates this process entirely for most families. Inherited traditional IRAs trigger significant ordinary income taxes for non-spouse beneficiaries under the 10-year rule. A large traditional IRA left to adult children in higher tax brackets can generate well over $100,000 in combined additional taxes across the distribution period. Roth conversions during the account owner's lifetime reduce this exposure at the cost of paying taxes sooner at the owner's current rate. Appreciated assets receive a step-up in basis at death, eliminating capital gains taxes for heirs. On assets with large embedded gains, holding until death is dramatically more tax-efficient than selling during life. None of these strategies require specialized knowledge to implement. They require updated beneficiary designations, a review of account titling, and basic legal documents such as a will and potentially a trust. Most estates can address these items for less than $5,000 in legal fees. The cost of not addressing them is frequently many times that amount. This is not legal or financial advice. Estate and tax laws change, and the right approach depends on your specific circumstances. A qualified estate planning attorney and a financial planner can apply this framework to your actual situation. If this breakdown helped clarify something you have been putting off, subscribe to CashCinema. We cover the real math behind decisions that most people find too complicated to calculate on their own. Leave a comment with the money question you want us to answer next.